Hello and welcome, Andrew Duguay, once again, Chief Economist on staff with Prevadere. Andrew, welcome back so soon. I know we just had the US Economic Quarterly Report with a special report on the coronavirus. And obviously, no surprise, it is Monday, March 9th, and this was a very exciting Monday morning and weekend with coronavirus and economic updates, global, China, including the United States. And I just wanted to check in with you, Andrew, to get your take on some of the pivoting and the shifting going on in the market right now.
Yeah, thanks, Nicole. I think it's interesting all the events that are happening, and we want to try to keep up with really how the markets are adjusting to this output. I think at a really high level, I think what's happening is that the coronavirus epidemic is really shifting rapidly from what originally looked like a temporary supply chain interruption coming out of China, which in itself was a big deal, but it's broadening to much more global and far-reaching market disruptions, and those market disruptions are crossing more and more industry sectors. So the deeper this gets and the wider this gets, the longer the recovery time is going to be, and so this could have real market implications for months and quarters ahead, rather than the initial fears of temporary disruption. And to start off, I think let's talk about what the markets were reacting to today, and that was that late last week it was a disruption of oil markets as OPEC and Russia, you may have read, were not coming to supply agreements like they had in the past, and the results have been a severe decline in oil prices globally. So oil prices were already falling, and I think that was really the stage that was set for this disagreement that happened. Oil prices had fallen around 30% since the beginning of the year up until last week, which is a rather significant decline. However, since the disagreement last week between OPEC and Russia, this has been followed by another 20% drop in prices, at least as of today, Monday, March 9th. So when we look at overall, we're looking at prices around $60, $65 a barrel, depending on whether you're looking at US crude or European Brent at the end of 2019. And now today we're looking at prices in the low 30s all across the globe. That's a severe decline. And when you look at oil prices, those are one of those key economic barometers of health. And this is going to spread across many industries. Of course, in the US, that is a rather large oil and gas petroleum producer, refiner, and supplier. This negatively impacts a lot of industries, even US industries. And so we think about that we're now kind of almost 2-3 degrees removed away from coronavirus itself to other market factors that are going on and causing markets to crash, and the stock market reacting negatively as a result. So overall, I think this points to some broader economic ramifications of this event. I think our customers who know what their top leading indicators are should really make sure they are paying attention to these developing trends and how the data is impacting their predictive models. On the consumer side, I think we want to keep a focus on how is this going to impact consumer spending. Consumer spending is, of course, a linchpin for most economies, and particularly here in the US. And so we've been eager to see how the coronavirus is going to impact those countries where this crisis started, and particularly the Chinese consumer. So we've seen a lot of data, including in our webinar last week, talking about the Purchasing Managers Index and disruptions to manufacturing logistics in China. But we have some new, fresh data from some of our data partners that we're looking at to analyze China consumer spending. And with China, of course, you have to look a little bit broader than just government headline data, right? It's always valuable to look at some private sources, and so we have some unique data partners that measure China consumer spend as well as consumer sentiment. With both those two indicators combined, what we get is actually a picture that shows that Chinese consumers are cutting back pretty severely on their spending on a year-over-year basis. Now, of course, Chinese New Year's thrown in there, but our analysis shows that if you look amongst a lot of broad categories of consumer spending, you look at the whole period of January and February compared to last year, and compare that to the normal seasonal trends and things that you would say as if this coronavirus never happened, what we're seeing is about 25% decrease in most categories versus trend. And so that's saying excluding Chinese New Year and all of those things. And so we could probably attribute most of this to hesitancy from consumers surrounding coronavirus, as well as travel restrictions and the like. And we're not seeing this just in brick and mortar. We're seeing this in some overseas spending, obviously with less travel, and even online retail transactions being down. So I think that's a pretty severe signal. So if we have the industrial manufacturing sector down, as well as the Chinese consumer down, right now China is in a year-over-year decline, a mini recession of sorts. Technically, a recession needs to go along 2 quarters, but for all purposes, the first quarter in China, I think, regardless of whatever headline number gets published, is going to be felt as a recession in all areas of China, at least from some of these real-time signals that we're getting. Switching back to the US, I think when we look at the US consumer, what we're seeing right now is a lot of market shifting. So people might be spending more on hand sanitizer and less on fresh fruits and vegetables, as they might be worried about the number of trips to the stores, and so they might stockpile on frozen foods instead. And there's a lot of good analysis out there being done by different category segments. Historically, as we mentioned in our webinar last week, what you see from these type of crises is that if they get contained soon enough, you're met with a temporary supply and demand disruption. People, reducing their spending on other things to buy more hand sanitizer, for instance, but followed by a quick rebound. I think we'll get more concerned if things start to continue to devolve in the US and the virus spreads, or these travel restrictions turn from days to weeks to months. That's when we'll start to see probably some real headline changes in consumer spending. But we do need to keep in mind the context of this is that here in the economic cycle, the US economic consumer is in a relatively stable and healthy condition with low unemployment rates and relatively high wage growth, that we would have to see, some periods of impact from this coronavirus before we started to get into recessionary territory here. So things are much worse in China. Here in the US, I think we're trailing behind in the signals. The signals aren't as strong, but we are continuing to watch them for some of these negative economic ramifications.
Thank you, Andrew. Quick question for you. Last week, when you presented the U.S. economic report data, you presented 3 rough scenarios, total overall U.S. economy expectations, considering the coronavirus in 3 different scenarios and how long it lasted. Are we still within those 3 scenarios that were presented at that time?
I would say those scenarios are generally good guidelines, and to refresh everyone, we talked about how when containment happens, what the ramifications could be, and we were talking about if containment doesn't happen by May, we're talking about a couple months of of this type of increased coronavirus spread. Then we could be talking about some real ramifications for the U.S. economy, include heightened risk of recession. Of course, when you went, and then somewhere in April means that it's going to be felt in the near term, but recovery in the second half of the year. And then obviously, if we contain it now, it's going to feel more like just that temporary supply disruption. However, with what the markets are seeing, is that this could accelerate even faster. However, the context is, I think, we don't know the rate at which it spreads. So when we were talking about these scenarios in context, it was kind of the coronavirus kind of spreads at the rate it was spreading, a couple weeks ago. If that starts to pick up and also spread more in the US than it has in the past few weeks, then I would say those timelines could get accelerated and we could be starting to see, more negativity sooner. However, we should keep watching the trends of how this goes. This may have been a bad week. There's some externalities that came with this, such as the OPEC Russia situation that have also been impacting the market. Those type of events might not happen every week or every day as we go through this crisis. And so yes, that timeline could get accelerated, absolutely, but we should still keep in mind the broader context of this is that what we are dealing with is still primarily a health crisis, and it doesn't necessarily need to turn into financial crisis if the health crisis is contained in a reasonable amount of time.
Great clarification points, all of them, and also putting the oil market disruptions into perspective. While it's happening at the same time as the coronavirus, just the overall strength of the economy and able to field impact of this temporary situation.
Yes, I think when it comes down to it, there is still some global demand, and so should the markets be able to stabilize themselves and the health crisis stabilize, there's no reason to think that we couldn't see a rebound on the back half of this. So while things might feel very recessionary at the moment, as they do when the market acts the way it does at the last couple of weeks, putting things in the broader context, I think there's still some opportunities for us to dig out of this. But a lot of it does, remain to be seen. So I think focusing on some real data rather than speculating and hypothesizing is really a key focus here at Prevadere, obviously being a data-driven analytics company, but also something we encourage for our customers to try to make reasonable business adjustments. Don't react too fast or too slow, right? Waiting for that recovery when your indicators are signaling something worse. So I think trying to be data-driven as much as possible is always good in the context of these times of increased uncertainty.
Thank you, Andrew, for all of that. Puts our minds at ease, and also just appreciate you taking the time to make the updates. You are a busy man these days with everything going on, so I'm sure we'll be in touch soon. Thank you again.
Yeah, thanks, Nicole. We'll stay in touch.
Okay.